All right, let's talk about the first big IPO of the year. It's a government-backed one, and it's in a sector that's, well, absolutely critical. We're talking about Bharat Coking Coal, or BCCL for short. So yeah, we're going to break down this public offering from BCCL. Now, you might know they're a key part of the massive coal India. And for any investor looking at this, the question is pretty straightforward, right? Is this an opportunity you should jump on, or is it something you should stay away from? Let's dig in and find out. Okay, so what makes this so interesting? Well, BCCL isn't just digging up any old coal. Nope, they specialize in something called coking coal. And this stuff, it's the one ingredient you absolutely cannot make steel without. I mean, think about that for a second. No coking coal means no steel. And that means no new buildings, no bridges, no cars. You get the picture. It is literally the bedrock of our country's infrastructure. So that brings us right back to the main event, the big question here. For someone like you, a retail investor, is this BCC IPO a golden ticket to owning a piece of a super vital industry? Or is there a catch, a hidden trap we need to know about? The only way to figure that out is to get into the numbers. All right, first up, let's build the case for jumping in. I mean, when you first look at BCCL's position in the market and how stable their finances seem, it really looks like an absolute fortress. Let's start with this number right here, 58.5%. That is BCCL's huge slice of India's entire coking coal production. We're talking about near monopoly-level dominance in a sector that, let's be honest, the country just can't function without. And it's not like they're going to run out of this stuff anytime soon. Check this out, 791 crore tons. That's how much they have in proven coal reserves. That gives them some incredible long-term security. We're talking about decades of supply just sitting there, locked in the ground. Okay, now for their financial health. And the number here is 0. A big, fat 0. That's how much long-term debt BCCL has on its books. I mean, seriously, in today's world, finding a company with 0 long-term debt, that's an incredibly stable and, frankly, very attractive thing to see. So, if we put it all together, what do we have? BCCL is India's only source for prime coking coal. Their production has been growing at a nice, steady clip. They've got a solid net worth. And oh yeah, their client list? Just a few small names like NTPC and SAIL. You know, the giants. On paper, you look at all this and think, wow, this has got to be a slam dunk. Which, of course, leads to the obvious question, right? If this company is so dominant, so stable, so critical, what's the catch? What could possibly be the problem? Well, this is where our story takes a turn and gets a whole lot more complicated. Okay, so now let's look at the other side of the coin. It's time to talk about the hidden cracks in this fortress, because believe me, there are some pretty big risks hiding just under that shiny surface. And here's the number that should make any potential investor stop dead in their tracks. A drop of 83%. That's a staggering 83% drop in their profits year on year for the first half of fiscal year 2026. A nosedive like that, well, it definitely needs an explanation. So, what on earth happened? You could call it a perfect storm, really. It started with heavy rains back in fiscal year 25, which totally messed up their mining operations. That, in turn, led to a direct drop in production and sales, which obviously hammered their revenue. And then, to make things even worse, their customers started paying late, so their cash flow took a massive hit. And this points to another huge risk. They're heavily reliant on just a few customers. I mean, look at this. Almost 89% of all their revenue comes from just their top 10 clients. Think about that. If even one of those big guys, say SAIL or NTPC, decides to cut back on their orders, it would have a massive, immediate impact on BCCL's business. All of this brings us to the real heart of the issue, the valuation. And honestly, it's a genuine puzzle. Because depending on which numbers you look at, this IPO is either a total bargain or it's ridiculously expensive. So here's the deal. It's like a tale of two valuations. If you look at their earnings for the full fiscal year 25, the PE ratio is sitting around 9, and that looks pretty cheap, right? But if you use their more recent, much lower earnings from the first half of 26, that same PE ratio shoots up to 43, and that looks really, really expensive, especially when you compare it to other similar companies around the world. So you see the problem, right? The valuation looks so high at the moment because that massive 83% profit drop has shrunk the the earnings part of the PE ratio. And that leaves us with $1 million question. Is this profit drop just a temporary blip, or is it a warning sign of deeper problems? Okay, let's bring it all home. It really is an investor's dilemma, isn't it? Let's lay it all out on a final scorecard just to see the pros and cons side by side. In one corner, you've got the long-term strengths, and they are powerful. You're talking about a market monopoly, huge reserves, zero long-term debt, and solid government backing. But in the other corner, you have these really serious short-term problems. That huge drop in profits, way too much dependence on a few customers, those delayed payments, and a valuation that right now just looks expensive. So in the end, it all comes down to one question. For you, as an investor, is the long-term promise of owning a true market leader worth putting up with all this short-term risk and uncertainty? And, the answer to that, it really depends on what kind of investor you are and how much risk you're willing to take on.